Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Josip Rupena. How you doing today, Joseph?
Doing great. Thanks for having me on the show.
Awesome. Well, I'm excited to dive right in here. Got a new topic, know very little about. So before we begin, tell us a bit about your background.
Yeah, so I started Milo about 5.5 years ago. My background prior to starting this company was working at large investment banks. I had started another business, but I was working with institutions, large individuals that had pretty significant net worths, and helping them invest, look at the world and trying to see how I could hopefully make them a little wealthier. And so that was the first part of my career, and then through that journey, saw an opportunity to build Milo, and I kind of ran out of reasons of saying no why I shouldn't do it, and then eventually had a pretty good group of individuals around me that supported me and got me going.
Nice. So tell us, what is it you do?
Yeah, so Milo is a company I started around the idea of being able to help people that had particular needs, specifically around buying homes and offering them mortgage and credit. And I started the company really focused on helping international clients that were buying real estate here in the U.S. A lot of those were my clients, and as a large bank, Morgan Stanley, we probably should have been doing that pretty well, given we knew a lot about them and had their wealth with us, and it would take a really long time, and that was something that I started to ask around and ask other individuals, is this common? Is this something that's happening? And I think that the assumption was, if there are wealthy people, they should be able to get mortgages and other financial products, but they couldn't, and it was very slow, and the process just wasn't great. So he said, well, we think we could do something around this, and raised capital from investors, and we got the company going with that basic idea, and a few years into it, really saw similar traits with people that had digital assets, specifically Bitcoin, and we started asking them similar questions. Do you have Bitcoin? And then they got a little sort of flustered, assuming I was going to now turn down their mortgage. So we saw very similar traits. I had been in the space, since sort of 2015, 2016. I assumed people could get mortgages given their net worth, and so we saw a lot of similarities, and decided to really pursue that, and we launched the first crypto mortgage in the world in 22.
Nice. So let's kind of go back to where you started. So you said you have international clients buying real estate in the U.S.
Yeah.
Why is that a problem? Like why can't they get real estate in the U.S.?
Yeah, so I think it was a challenge because these were individuals that were fairly wealthy in their home countries, right? Mexico, Canada, Brazil, UK, right? A lot of the developed countries, and they really wanted to invest in the U.S. because they wanted to have an investment where they felt there was safety, stability, right? All the things that the U.S. is known for, and and the world appreciates. And a lot of those individuals were also starting to send their kids to school here, and they wanted to buy properties, and they wanted to make sure that they were housed properly. And they had pretty significant net worth. A lot of their net worth was with private banks and wealth managers here in the U.S. But they didn't have a social security number. They didn't have tax returns in the U.S., right? They didn't document income here. So that element of having a different financial profile made it very difficult for them to get a mortgage unless they were working with some very specialized local regional bank, where that process could take 60 days, 90 days, 120 days. And a lot of times what ended up happening is that they would just buy these properties and not take out a mortgage, even though they would have liked to. And if you would have taken the same profile of customer and you would have made them a U.S. person with those items of social security number and tax returns and everything else, they would have been a super prime, highly sought after client. And that was sort of the gap that we saw, where here was an individual that had a pretty significant net worth, and um, still could qualify.
So what's changed? Because I would have assumed that it'd be a lot easier to get a mortgage. So what's changed, and why aren't banks lending to them? I would think that it would be an easy thing to do.
Yeah, I mean, it really comes down to a lot of the mortgages that are originated in the U.S. end up going to, Fannie, Freddie, and sort of the GSEs, right? The federally sort of subsidized, government entities, which are in the business of effectively buying mortgages. So the majority of the mortgages that get originated, roughly 2 trillion, go there. And then if you think about the other part of the market, which is the sort of portfolio market, which goes on banks' balance sheets, those that in that market, there's not a very strong incentive in a rising rate environment for these individuals to hold these mortgages on their balance sheets. So they don't really want to take on risk. And then these are individuals that are qualified in the sense that they have a pretty significant net worth and they can purchase these properties in cash. They can't necessarily take any type of interest rate. So it still has to be somewhat competitive, right? You can't charge them a rate that is significantly higher, right, than the market rate. So it really turns out that most banks are just not lending, and most of these banks don't necessarily have the expertise to work with this set of customers, given their profile and diversity of all the different countries that they're from. Doesn't mean they can't. It's just a business decision, and they focus on another set of consumers.
So, it's interesting. I mean, you say I totally understand if it doesn't fit in a small little box, they're not going to lend. Um, I mean, that's true here. They don't even have to be international.
Yeah,
I mean, you could be
absolutely.
wealthy here and not have a W-2 income. I know there was a time uh, after the great financial crisis that, I mean, I had a friend, he had over $1 million in cash. He wanted to buy a house for his mom and couldn't
Yep.
because he had just started his company and he was making, like $500,000 a year and could have easily uh, bought the house in cash, but
Yep.
chose not to because it was a really low rate. And the banks wouldn't lend to him because
Yeah.
he needed 2 years in his business, not one. And
Hmm.
it's so ridiculous, but it's almost like they don't want to lend now
Yeah.
unless you're in the
Yeah.
perfect little bucket.
Yeah.
So how is the market adapted to that? Because obviously these people are still getting mortgages.
Yeah. I mean, I think it's sort of an evolution of the workforce, right? In the US, where you think about, 20, 30 years ago, where it was very common for someone to, be in a job and have a W-2 and, have a really nice, consistent, income stream for 10, 20 years. And then now you've got significantly more people that are self-employed and, the upstart is sort of, the gig economy and people that don't necessarily have this really nice, documented, consistent income. They have assets, they have other forms of assets, right? Like the individuals that take our crypto mortgage that have Bitcoin. So the world has changed. And I think a lot of the sort of legacy mortgage industry is still locked into sort of the way that it was previously. And there's all of these gaps for these consumers, right? The high net worth US consumers that you alluded to, or self-employed, or entrepreneurs, right? They're not going to conform. They're never going to fit that box. And I think that's where the opportunities lie for companies like ours and others that decide to look at it and figure out how they can finance themselves. And there's a whole ocean of customers that are frustrated with this sort of legacy system, and I think that is starting to change with certain pockets. There's the evolution of the non-conforming mortgage market, meaning individuals that are investors, individuals that are self-employed, and other forms of mortgage programs to be able to document their income, and it's allowing them to qualify. So I think we are heading in that direction. It's just a slow transition into what I identify as probably a new normalcy of how people work and what their income looks like.
So if you've found a way to fill that gap, are you effectively a bank? I mean, is that
I mean, we have relationships with banks and different institutions that will finance us, and then we're a lender. So we have our own guidelines and criteria of how we want to lend and what works and what program we offer. And that gives us the flexibility to be able to look to a customer, offer a particular program that we can actually deliver and close and transact. And then behind us, we have relationships with institutions that allow us to finance ourselves, not being, a deposit taking financial institution like a bank. We have some limitations, but ultimately that's the sort of the balance that we've been able to find, is to not necessarily just be a broker hoping to try to originate a loan and then hoping that someone else approves it. We need to be able to face our customer. That's how we're able to build technology to be able to close in weeks and not necessarily months, right? For us to be able to control the process.
so? So how does that work? So let's say you have $1 billion, let's say you have $100,000, so just for sake of argument, and somebody wants to borrow 100,000. Are you are you able to leverage that like a bank would, or do you have to borrow $100,000 to lend that out and then you keep the loan on your books, or are you selling it? Like, how does that work for you
A
guys?
combination. And sometimes there's loans that sit on our balance sheet directly, and then sometimes there's loans that we have some of these institutions that want those assets for the duration because they do have longer, more permanent capital where they're really looking at collecting interest for a long period of time, similar to a bank or some type of structured credit fund that is looking to do that, and or the securitization market, which is this other vehicle out there, right? The majority of sort of the Fannie Freddie loans are securitized, meaning packaged together and ultimately delivering a more diversified profile for an investor. And that happens also in this less conforming market, right, in the mortgage market. So we've been able to originate loans that have gone into that market, and that allows us to be able to offer rates that are more competitive than if you were to just say, okay, I need to borrow money at 10, I need to lend it out at now, hopefully something higher, right? 11%, and maybe I'll make a percent, right? This allows you to really think about it a little differently.
Okay, interesting. Yeah, how's the market now? Is it harder or easier than it was I don't know, say maybe like 5 years ago? Is it kind of loosening up, or like where what does the market look like for
I think
mortgages?
I think it ebbs and flows, right? So if you think about a lot around mortgage is a function of interest rates. As interest rates were lower and they perceived to be lower for longer, people were hoping to be able to go into certain pockets to be able to capture a little higher interest rate. And they were willing to take on more risk maybe 5 years ago, 10 years after the financial crisis. And then now you're starting to see that because home prices have appreciated pretty significantly over the last 3, 4 years, people are definitely being, and institutional loan buyers are starting to be a little bit more conservative with what they're looking for and maybe making the bar a little higher to qualify. And it also means that, maybe a loan that in the past you might have made 2% on, now you can make 8% on. So you don't necessarily want to take necessarily that much credit risk around it. And people are pretty happy with getting this sort of excess yields today, right, on mortgages. So I would say the market has tightened up recently, right? Meaning the qualification, it's a little harder to qualify. I think also it's a function that their mortgages are one of those assets where if rates go down, people tend to prepay faster, right? They're going to be able to refinance, they're going to get a lower rate. So there is some sensitivity around that. But I think to answer your question, I think that more recently, I think the market's gotten a little bit more difficult to get approved for a mortgage, primarily because people still have the PTSD of the financial crisis, and they're looking at that as, well, I remember what was done, 15 years ago, 16 years ago. Let's make sure we don't do that again, right?
So I'm curious because I'm not sure it's still this way, but for approximately 2 years, we had an inverted yield curve, which is basically how banks make money.
Yeah,
But they were still lending. So how are banks able to make money in a time where they, for all intents and purposes, shouldn't have been able to make money?
yeah. Yeah, it's really leverage, right? I mean, when they're in a situation back then, they're able to issue loans and they can make a little tiny spread on what their cost of capital is. But if they're able to lever themselves, 5, 10, 15 times, that little turns into something that is a reasonable return on their equity. That also means that as interest rates rose, those loan assets were effectively worth less because of the element of interest rates being high, right? That asset is worth less. And interesting from a bank perspective, they could basically put those assets and not have to mark to market them on their balance sheet. That's what allows them to really make those decisions, which is not optimal because there's an opportunity cost. If you have a loan on your books that is at 2%, and today you could be making 8, right? There's a pretty big opportunity cost. So for a lot of those institutions, they've really been focused around being able to capture deposits so that they can put new money to work at these higher rates. And then hopefully as rates start to come down, they're able to offset it. And, overall their portfolio, tends to sort of balance out. But that really is a big function for them, is being able to get new capital and access to funding, and being able to, compete with, some of the money markets, right. And treasuries, which have been, T-bills that have been pretty pretty high, right? Around the sort of 4 or 5% now for the last 18 months, right? They're competing against that, which has eaten into their margins.
I know back in the financial crisis, they suspended some rules and they allowed them to, we called it mark to magic, where they
Yeah.
just make up numbers what it was.
Yeah.
Is that still suspended or did that go back to normal?
No, I think that's still in effect. My understanding is that they still have assets that they don't necessarily have to mark for interest rate sensitivity as long as they're holding to maturity.
Right.
Now, the real cost is the opportunity cost of now having a dollar invested at 2% instead of a dollar invested at 5, right? So they won't necessarily take a loss. They just won't make as much money, right?
Yeah. Well, there's at least one big bank that is definitely doing that. I won't mention the name,
Yeah,
but
yeah,
yeah, they're in trouble. Their deposits they're paying like 10 basis points still, even though everyone else is getting 4 to 5.
yeah.
All right, well, let's get into how Bitcoin and digital assets get into this. So you talked about having a Bitcoin mortgage. So tell me about that. How does that work?
Yeah, so what we were trying to solve for individuals that had Bitcoin, and if you think about, this is a consumer set that bought Bitcoin, well over 10 years. Some of our clients, bought Bitcoin at $50, $100, and we're fortunate enough to be able to invest 10, 20, $50,000 into Bitcoin at that time, and I've had the fortitude to hold for a long period of time, and because of that, if they wanted to buy a home today, they would have to sell, and that would trigger capital gains for them. It's a taxable event. And also, for many of our clients, including myself, right, I think that one of the greatest returns you can generate is just basically buying Bitcoin and holding it for the long run, right, from a supply and demand perspective. And so there's the opportunity cost of potentially selling their Bitcoin for a home. And then the third thing was a lot of these individuals, because they do have income, but they've got significant Bitcoin net worth or amassing net worth in digital assets, they may not be able to qualify conventionally, right, for a mortgage, like we just discussed. So what our crypto mortgage does is someone wants to buy $1 million home, they post $1 million of Bitcoin with us at Coinbase and BitGo, which are qualified custodians to hold Bitcoin, and we'll finance 100% of the transaction. So they want $1 million home, we'll finance it. So it's 100% loan to value on the transaction. They don't put a down payment. They don't need to put a down payment. The Bitcoin is still theirs. They still own it. And if Bitcoin appreciates, it's their appreciation. And if the home appreciates, it's their appreciation. And what do we ask in return? They pay us a slightly higher interest rate than a conventional rate. Right now, mortgage rates are somewhere in the sevens, we're somewhere in the nines. And we really alleviate, those three things, right? It's not going to trigger a taxable event for them. They're going to continue to own the Bitcoin, and they're going to be able to qualify and buy a home. And the combination from an investment perspective of holding a home, which is a great wealth creating asset, alongside Bitcoin, which also has historically appreciated at a very, very healthy clip, and for the foreseeable future, it looks like it'll continue to appreciate. You combine both of those, and you look at a home where now you're not putting any money down, so you've got a tremendous amount of leverage, right, into the asset price. It turns out to be a phenomenal return, and we've seen that play out for many of our customers since we started originating in 22.
All right, so let me get this straight. So how much of the Bitcoin do you have to put in to cover the transaction?
Yeah, so we're going to ask, so the equal amount of the loan. So if they want to borrow $1 million, they're going to post $1 million of Bitcoin. They want a $500,000 home, it's going to be $500,000 of Bitcoin.
Okay, so you don't worry about what the real estate's worth. Is it also backed by the real
I mean,
estate?
it's we're going to have a lien on the property as well as basically the Bitcoin. What does the
Okay.
Bitcoin do for us in reality is it allows us to underwrite a consumer where if there was any issues with them making payments, we could sell a little bit of the Bitcoin to make the payment. So that allows us to be able to underwrite a consumer where maybe an institution or bank or some other type of lender may look at that and say, well, we need you to conform to this way, and understanding that it's unlikely to be the case, but it doesn't necessarily mean that the customer is any riskier because of that.
Okay. So if you're buying $1 million house, you have to put $1 million of Bitcoin and the loan's covered by the house and the Bitcoin. So you got 200% covered. So that's pretty good. So that's pretty low risk for you guys.
Yeah.
And you get a higher rate, which is interesting. Um So I guess for the consumer though, the downside would be, well, now you've got your Bitcoin sitting in a custodian, so if it ever gets stolen or hacked, then I mean, part of the reason people keep it out of the custodians because they don't want to get it hacked and stolen.
Yeah.
So
Yeah.
what's the reassurance that that's not going to happen for the consumer?
I mean, I think for us, it's working with qualified custodians and keeping it with two firms that have significant insurance policies, as well as the Bitcoin. The way we hold it is it sits in cold storage, so it's segregated from the accounts of them. So I think that we've taken sort of those necessary precautions to be able to make sure that it is secure, and working with groups that are qualified custodians, right? So if think about Coinbase, many or the majority of the ETFs, right, the Bitcoin that they hold is held with Coinbase, right? It's held through sort of their prime brokerage relationships, and we have a very similar infrastructure that they do to be able to manage these assets, right?
How, I mean, if somebody's doing a transaction like that, how long do you think they do that? Is that something that they're holding on to for 30 years, or is this kind of like well, I'll do it and then I'll refinance out like 2 to 5 years later? Like, what does that look like on your side?
I mean, I think it varies. I mean, we've definitely had some clients that took out loans with us, a few years ago and have paid them off. Some of them have paid it off because in that period of time, Bitcoin appreciated so much that they were able to take some of the gains and decide to, reduce their loan balance or pay it off. Now, that's a very personal decision for them. I think mathematically, right, if you bought $1 million home and you sold $1 million of Bitcoin, and Bitcoin is now worth 3 times more, right? That effectively turns into a $3 million home. So you may not want to do that. I think the way we look at it is from a total return perspective. If you're saving money up front from a tax perspective, your payback period on the higher rate, is 5 or 6 years. Given that you didn't pay the upfront capital gains taxes, right? If you pay capital gains, you're front loading your cost, right? All up front.
Right.
So, we think that these individuals continue to benefit from holding it for the long run.
So how does that work? Let's say you put down $1 million in Bitcoin, and then Bitcoin is in that case that you're holding for them is now worth 5 million. Do they get the 4 million back, or you have to still
They
sit
get the
on that
same
same?
amount of notional. So, if they give us, if they posted 10 Bitcoin, they're going
Yeah.
to get back 10 Bitcoin. Now, those 10 Bitcoin are going to be worth significantly more, right? The way we think about it, they're going to get back more dollarized value, right? But it's the same Bitcoin that they posted with us.
I meant for security though. I mean, just like, can you free that up at some point, or is that always securitized the same 10 Bitcoin for the whole period?
Yeah, we've done situations where we return collateral to clients if there's significant excess.
Okay.
It really just comes down to their pay history and and sort of factors like that. But yeah, we're definitely not in the mindset where, again, it's a liability to us. So if they want their Bitcoin back and it makes sense, then we do that.
Okay. That makes sense. Um, cool. This is an interesting idea. How much interest have you gotten from the Bitcoin community? I mean, it tends to not be all that big for people who have huge amount of Bitcoin.
Yeah,
They
I
they
mean, look,
probably
there's
do, but there aren't that many of them.
no, I mean, there's a lot of individuals. I mean, I think that's one of the things that we really like about the consumer side and these individuals, and we want to continue to build and offer more products for them, is because their net worth is continuing to increase, right? When we started doing the first loan, Bitcoin is up 2 to 3x from that time and place, and there were individuals that reached out to us at that point in time and they didn't qualify, and today they do. So we hope that many individuals continue to amass Bitcoin, and that continues to increase, and our opportunity set of customers that we can work with will continue to grow, and that'll also be a function of maybe in the future, as we think about how we finance ourselves, maybe we don't need 1 million for 1 million, right? Maybe it's less. Maybe it's a different form of asset, right? So I think we're looking at all these different permutations of the offering to be able to work with more individuals, but really with the mindset of hoping that individuals don't sell their Bitcoin for the real estate transaction or for something else, right? That they can continue to hold it and they don't have to make the choice between one thing or the other, right? If you have a stock portfolio, right, you can, and it's decent size, you're going to be able to margin it, right? You're going to be able to borrow against it and access liquidity when you need it without having to sell your positions. And in a way, right, that's what we're trying to do with our crypto mortgage. And then, we also have a crypto loan product which allows them to borrow against their Bitcoin and be able to use those proceeds for whatever they need to as well.
So how do the crypto loans work? I know that a few companies went under, and there was some
Yeah,
shenanigans that went on with some other companies.
yeah,
How does all that work? I mean, I would imagine there's some challenges there with the large swings in the price of Bitcoin.
yeah, yeah. I think that there's a lot of from a press perspective, and a lot of the sort of headline was that these companies failed because of this, and the reality is that couldn't be further from the truth, right? Most of these companies had very, very diversified businesses with multiple different business lines, and failed for a multitude of reasons. The product in itself and the people that originated and the lenders, the majority of them never suffered any losses or related to the product. And the reason for that is someone who wants to borrow $100,000 posts $200,000 of Bitcoin with a lender, and if the value of the collateral drops, they need to post more collateral, or the collateral gets liquidated and the loan gets paid off. So if you're a lender, you have far in excess of collateral, so you're really covered and protected. So where would you lose money? It's really if you're not able to, liquidate the collateral, or you don't have, the right mechanisms in place. But otherwise, as a lender, you're pretty secure. Now, from a borrower's perspective, really that's the trade-off, right? There's no real underwriting from a credit perspective like a traditional, personal loan, but it's an asset-backed loan. So in the event that the asset drops, right, that's going to trigger certain elements. But I think there's ways of mitigating it, right? You could post significantly more collateral, you could post additional collateral, right? There's different ways of working through that. But for the individuals, it's a good trade-off because for example, with us, if a client needs $150,000 and they apply right now, we're going to be able to give them $150,000 within a couple hours, same day. It'd be very hard to be able to achieve that through a personal loan or some other type of credit product.
Now, do you create customized lending as well, or is it all pretty standardized format that you guys have?
Yeah, we have a digital platform that we've built where customers can come in and apply, and that allows us to be able to be efficient and scale and take lots and lots of applications every single day. But there's definitely situations that sometimes we need to talk to a client, and we can look at something that's a little bit more bespoke.
Yeah. Because I was just thinking, I mean, if you mentioned the, people using leverage and paying it back with crypto later, and I was thinking, well, what if you just went in and created a loan with Bitcoin, at the low, after it drops 70%, and then you have it paid off every 7 years with a percentage of that,
Yeah,
of the gains, and that's it. And you're not paying monthly payments. You're just
yeah,
paying like, one chunk accrued interest for 7 years with the Bitcoin, and then obviously that would be a leveraged way to do that.
yeah,
So
absolutely. I think there's a lot of ways of really thinking through that. I think that we're really trying to solve for people, to hold the Bitcoin, and, if it appreciates, and, that allows them to sleep at night because they don't have any debt and they want to pay it off, or, want to be able to, prepay monthly payments to not have to think about it. That's also an option, right? I think that the whole point here is that the customer is in control of how they want to handle this, right? And I think that what we have seen is there's just so many of these individuals that just haven't bought homes, and now we've been really active because the housing market is no longer as competitive as it was a few years ago, with prices only going up and to the right. Homes are prices are a little flatter, and some markets starting to decline, and the net worth of these individuals still remains pretty high, and and hopefully, right, continues to appreciate as Bitcoin does. So we're finding that this is probably a good time for these individuals to at least start to explore what their options are with us and their crypto mortgage, and see if it's a right fit. Maybe there's another type of loan that we offer that's a better fit, but really starting to do their homework, and hopefully go home shopping and pick up something that maybe is at higher than what it was in 21, but maybe not as high as maybe they were hoping to sell last year, right? Where prices are coming down and people are a little bit more realistic to transact.
yeah, nice. Awesome. Well, Joseph, I really appreciate you coming to the show, sharing your wisdom with us. Final thoughts, and where can people find more about you?
Yep. So our website is milo.io. Then if there's any questions that are direct, you can go to loans, LOANS at milo.io. I'm also on Twitter and LinkedIn. You can DM me directly or my team. And yeah, excited to be on the show and share some of these insights with your viewership.
Awesome. Well, thanks for coming on, Joseph. Looking forward to talking with you in the future.
Sounds great. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Josip. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Doug Hagerin. Hey, Doug.
Hey Kirk, how you doing today?
Doing great. Doing
Good,
great.
good.
We also have our very own Diana Perkins. Hey, Diana.
Hi, Kirk. Thanks for having me.
Yeah, glad to have you on. Well, let's dive right in. So, Doug, what were some of your thoughts from the interview?
Well, I think for me, one of the things that stood out is interesting is that first of all, I think there's still a very thriving international community that sees opportunity to invest in the United States. I think that's important. Real estate, we talk about it a lot, you and I, and kind of where that's going and the impacts of it. And there's a lot of charts and data out there about a couple things. I think a big overlying thing is store of value, right? Obviously, we're talking about crypto, store of value, but obviously investing in real estate in the United States is still considered to be a very significant store of value, right? These are people that have money. Whether or not these are smaller loans or larger loans, they have money. They've put their money, they've for whatever reason, again, wherever these international buyers are coming from, whether or not they're in a country where they trust their currency value or not, they have elected to put their money in crypto, and he's found a niche to obviously take that and be able to lend so that they can then take their money and put it in real estate. Which is kind of a 2x on store of value option there. And I think it says something very, very prominent about where people feel that there is still an opportunity to secure their wealth. And it also, I think, says a lot about the international community, the international middle class. Obviously, we live in this insular United States where we're still kind of like it's all about us, and the rest of the world is continues to grow up.
Yeah, no, agreed. Diana, what about you? What are some of your takeaways?
Yeah, so I'll say I love guests like Joseph who find this, gap in the markets and completely capitalizes on it, and especially in the area of cryptocurrencies, which I find is fascinating. So, in this area, right, he finds, this group, international buyers, they're well, high net worth individuals. That's where his experience is. And they're essentially being underserved, from his perspective by US banks. So he's essentially creating this bridge, right, between the traditional banking system and cryptocurrencies and finding a way to help this group, get funding to purchase property in the US. So I find this niche really interesting for several reasons. I mean, one, because it is so specialized, but two, it opens the question around, or the topic just around how finance is evolving and how, international perspective versus domestic perspective. I know we talked about this a little bit, offline, and different ways that blockchain technology is being leveraged, and how those who are highly invested in digital currencies, what opportunities are opening up for them. So really, really interesting conversation. Definitely see some pros and cons, or I'll say risks to this type of investing also.
Yeah, I find it interesting. I mean, I love the fact that crypto's getting, its share of interest from the fintech community and from people just trying to find ways to integrate it into technology and finance. I certainly have some questions though, right? I mean, you're talking about a totally different asset and tying crypto to other assets, all of a sudden it makes things more interesting. But I think the maybe the unknown unknowns are potentially the issue, and maybe even some known unknowns. But I think with new things come challenges. So some of which we can't necessarily foresee or don't. So Doug, what are your thoughts? I mean, doing something like this all seems great, using crypto, buy a home, borrow money. What are some risks that you think people should be thinking about?
Well, I mean, obviously, one of the biggest risks is valuation risk. I mean, crypto is done really well. I was, thinking about his strategy right now of taking this money and now being able to kind of use that as collateral for to be able to give out, a tremendous amount of risk to take the money and move it offshore, or into their pockets, at least on paper, and then into the real estate. And as long as crypto has done what it's done, then he's sitting really well. I mean, I'm looking at just kind of where Bitcoin, for example, went in the last 5 years, and where real estate in the United States has gone in the last 5 years, which it is certainly it's gone up in pockets, it's gone down in many pockets, but I would say for the most part, especially since we started raising interest rates, things have stabilized there. I mean, he's sitting, as long as they could, they're probably for that borrower, they're sitting in a very precarious spot because right now the collateral that they use to borrow these loans, which at the beginning was like, look, he gets to keep it if we default. Well, now those individuals, let's just say they borrowed $1 million, right? And so they gave $1 million in crypto at the time. That $1 million could now be worth, that he's got as collateral could be worth 1.4, $1.6 million, right? And the real estate itself or the loan itself is out there for $1 million, for $1 million. So now I think, his risk has gone significantly down because he will greatly benefit if they default. Now, on the other hand, there is still a lot of question marks around the valuation of these types of assets. They're not tangible. And there is always going to be some sort of caliber of value of something that I can go put my hands on. If I can hold it, I can see it, I can touch it, there's something real about it. Now I know that there's a belief that that cryptocurrencies and such is real, and at the blockchain level, the technology is absolutely real. But there are still some variables out there in terms of the fact that it is technology based. We've seen this over the last, well, since technology really started to take off in, let's just say, the 70s, 80s, but really 90s plus, we've seen technology evolution increasingly make former technologies obsolete. And so there's nothing that can't say that what, these technologies, this blockchain technology, Bitcoin, Ethereum, whatever that is, could potentially become obsolete by the next thing that takes it over. One of the things that could also make it obsolete is there has been talk in the last several years of being able to have algorithms now that can crack the encryption at a faster and faster rate. If it gets to a point in which all of a sudden the security of it, which is one of the things, that they have certainly looked at, is the security of the technology, get it off the exchange. And we've heard the billions that have been stolen, or disappeared, people losing their password, things like that. Or if we all of a sudden get into a scenario in which it is able to be something that governments, regulation around that can control it more because the governments are trying to do that. They can see it, which takes away from the mandate of being outside the system. If they can somehow absorb it into the system, makes me think of kind of NIL and sports, but I'll give that for a different context for a different day. Ultimately, the risk there is that this is something that is very hot, very exciting, potentially is going to be the future of currency and obviously therefore a store, some people would argue a store of value. I call it an appreciated, speculative asset, which is very different. But as long as the value stays to the point in which that risk is mitigated, great. But those are a couple of the things that could all of a sudden, I mean, you could turn out one day and you've lent $1 million out to someone in real estate, which has its own risks, which we've talked about. And then all of a sudden you find that this collateral is worthless as well, because of any number of variables. And now there is a tremendous opportunity for massive loss. But do I see that happening? No, and certainly not in the short term. Certainly, probably not under the terms of the lending that they've done. But I would say that is, absolutely a risk. And you are dealing with individuals who are outside of our borders. So the people you're lending to aren't necessarily under the same regulations as well.
Yeah, no, that's a good point. Diana, what about you? I mean, you're an options expert. You have a pretty good sense of risk. How would you look at crypto mortgages or even, crypto or DeFi finance? Like um how would you handicap this?
Yeah. So I love the topic of risk. So first of all, any market, the most difficult thing to do is time the market, right? That's why so many people who trade options, right? Where there's a defined contract end date, it's very difficult. It's one of the hardest variables. So I see risks from both the borrower and the lender side. I'll start with the borrower, right? So first and foremost, Doug certainly touched on it. It's the valuation. So digital currencies, yeah, over the long haul, Bitcoin, right. It's especially, back in 2017 to date, I think it's around $114,000 right now, but it's volatile, right? I agree, it is speculative. The world, companies, individuals, governments are finding new ways to leverage blockchain technology and to leverage digital currencies, but there is that volatility, that speculation involved. So from a borrower's perspective, that margin call risk, that's the first risk that I see. If during the term of their loan, if the value of Bitcoin that they're using as part of their collateral drops significantly, they're going to need to pony up more money. Now they're doing that while they're also paying off their loan. And so the good news is these folks, they already have quite a bit. I think the minimum is around $200,000 to invest with Milo. So they already have quite a bit invested in this digital currency. So they may be accustomed to that type of risk. But I would say margin call is number one due to the volatility and speculation of digital currencies today. Number two, I would say custodian risk. I know this was touched upon a bit during the interview, where the assets are primarily or maybe wholly kept in, cold storage. There's insurance involved, but it's definitely different from bank assets that are FDIC insured. So there's going to be a greater custodian risk there too that I see. And then the third risk from the borrower's perspective would be on the interest rate side. Obviously, Joseph, his team, the company, they're aware of the higher risk. So they're charging, a higher interest rate. So as long as a borrower, you can stomach the valuation risk, the essentially the storage risk, I'll call it, or security risk, more accurately, and then interest rate risk. And then, of course, from the lending perspective, from what I understand, they're using the value of the home in addition to dollar for dollar, the Bitcoin that's held as collateral. So that definitely limits their risk to some extent. But when your entire backbone is digital currency, that, in and of itself definitely justifies that higher interest rate.
Yeah, it's interesting. I mean, you guys raised some good points. It's what I find interesting about blockchain cryptocurrency is that the libertarians love it, right? It's freedom. It's they say it's freedom from government oversight and control. Although in reality, the government can use a lot of it to bag people that have broken the law, more so than they would like. But I think the idea of crypto and blockchain is great. The interesting thing I've seen is over the years is you know, the uh, the people who are kind of breaking new ground with blockchain are taking huge risks, which anyone who does is taking risks. But things that have happened, right? You look at like Celsius, right? Celsius Network filed for bankruptcy a few years ago. I think it was 2022. Um, you got Sam Bankman-Fried, you got Mount Grox. Like there's a whole bunch of these things that have happened over time that I think initially people didn't expect. Like you didn't expect somebody like Sam Bankman-Fried to um basically be thrown in jail because of I don't know the exact charges. I'm not gonna say them, but let's just say he's in jail for something. I just don't know exactly what the charges were that they got him on. But the point being is he made some mistakes, um, and clearly made some mistakes, and a lot of people lost money. And these things happen with new technology. And in large part because some people make mistakes, some people defraud people. Like there's a wide range of things. But at the end of the day, when you have new technologies, you also have fraudsters. You have people who are willing to take advantage of others. And as much as people like myself like the libertarian ideal, I also realize that we need laws. We need laws to protect people from other people. And, there's a healthy balance in there. But the challenges with these new things is you can't always foresee what the issues are going to be. Now, way back, I would say 2018, I had some clients who had some crypto, and they're like, "Hey, I want to borrow off the crypto." I was like, I don't know if that's a good idea. We kind of talked through the hypothetical risks, and they were using a notable company that did that, and the company ended up not, let's just say, not surviving. I won't name them, but they didn't survive, and neither did his crypto. So, I think the challenge is when you look at something like Bitcoin, which your keys, your wallet, your keys, your ownership, and people know that they own it. But when you start layering in all of these other systems or technologies or risks, let's just say, your risk of loss goes up, right? If you hold your own keys, the risk is that someone steals it from you or you lose them or you can't remember your password. Those are the risks. If you put it on a custodian, well, the risk is the custodian goes bankrupt and there goes your crypto because there's no FDIC created to protect you, right? So if you lend it, there's another layer. If you do this other system, there's another layer. So I like to think of things as layers. The more layers, the more complexity, the higher likelihood that people are not going to foresee the risks. Look at the global financial crisis. That happened because no one was looking at the documents, except for Michael Burry, apparently. But everyone else wasn't looking at the documents. Nobody knew that, what was it in The Big Short? They said it's dog shit wrapped in cat shit. Like that's basically what these mortgages were that they were creating. They just put a bunch of crappy mortgages and package them up, and all of a sudden they're AAA. And that happened. And we all know what happened because there were books and movies and all this stuff done about it. And I remember living through it. It was kind of interesting. Um, but that happened because of complexity. It wasn't one mortgage that caused the global financial crisis. It was systems upon systems upon systems that relied upon algorithms and theories that weren't necessarily accurate. I mean, at one point there was one guy who was really smart, and he wrote basically an algorithm. Everybody used it, and it was only a theory. It wasn't 100% correct, and because of that, I wouldn't say the whole financial system melted down, but it was a big contributor. So, you know, I think the challenge as you layer in complexity and fintech and all these other layers is you have these unknown risks that happen and multiply because people are trying to make things simpler and easier. And at the same time, they're making them more fragile. Right? We talk about fragility on the show from time to time, and fragility is a system that's become easy and everything's easy, so people don't pay attention. They stop reading the prospectuses. They stop paying attention. They just think, oh, the market goes up every day. I'm not worried. It doesn't go down. And then one day everybody loses half their stuff, and they're like, what happened? Like, well, you weren't paying attention. That's what happened. And that's fragility, right? And so more of these systems that are created, the more fragile the system becomes. And one day somebody blows the house down. You're like, what happened? Everything was easy. So I think those are, in my opinion, those are some of the risks that people need to be aware of. Now, it's not a characterization of what Josip's doing. I think it's interesting. I think it's a natural outgrowth of where we're going. I mean, cryptocurrency, what's different from a mortgage in Bitcoin as a mortgage in US dollars or mortgage in yen? I could take out a mortgage in yen right now. We'd have to find a bank to do it, but I could do it. So why not crypto? Why not gold? All of these things are possible. So the question is whether you should, but that's another question altogether. So, um, so where do you think? So, Doug, I mean, we talk about this a lot in the show, but there's a lot of innovative fintech out there. Um, I was talking to somebody the other day who was talking about doing 24/5 trading, just 24 hours a day trading. Is that a good idea? Should we be doing this? Should we be tying, cryptocurrency to mortgages? It's great, but what should be people be doing, and where should they be drawing the line, and not get too caught up in the weeds and all the cool stuff that like companies like Robinhood come out like, oh, cool, we got this new thing. Like, should people even be doing that? What do you think?
Right. You hit on something a second ago as you talked about fintech, and this is what. So you and I play in the space of the financial services industry, and there's a group out there that is kind of a consultant coach to the financial service industry, and they periodically update what they call the Financial Advisor Tech Solutions Map. The Financial Advisor Tech Solutions Map, when he first came out with this, had 10 technologies on it. The latest iteration of this map now has something like 37 categories with an average of probably, let's just say, 10 to 15 technologies each. Do the math quickly in your head. This is the world of technology that's just happening in the space of trying to be able to have communications around financial planning concepts with specialized planning or CRMs or document management or stress testing or risk tolerance or 401k or prospecting, lead generation, etc. Okay? And yet it is absolutely overwhelming to take a look at this and go, what should I use? And now you're going to apply that to people's money? Every day, as I said before, new technologies are coming out, and they're coming out at an exponential rate of creation that is absolutely taking something that was really working right now and making it obsolete. It's funny because I go back and I take a look at The first portable, I was one of those. I was a gadget junkie. And I remember when they came out with a portable DVD player. There's a little screen on it, put the DVD in it. And man, I bought that thing because I was traveling. I'm like, I'm on planes and this, it stinks to be on planes. I'm going to be able to bring my movies with me. And that thing was something like $1,700. Now that's back in like, I don't know, 20.
That's like $1 million in today's
Yeah, right.
money.
That's like in 2020 dollars, man. It's like, that thing it would be probably like in today's dollars, 5 to 7 grand. I mean, but it was like, okay, this thing's transcendent. Well, guess what happened? Several years later, all of a sudden, planes, you could get it where it's, the iPhone changed everything, right? Comes to your phone, it's streaming. Now every seat in the Delta has a screen. And this thing, by the way, the backup battery just to have enough storage for a flight was probably 700 of that dollars. But the point is that, and that took maybe close to a decade to become obsolete. So I got my use out of it. Now, the technology that comes out is obsolete sometimes in months. So let's take a couple things we'll look at these new, shiny new things. First of all, mortgages are different. A mortgage is not a Robin Hood trade. You're talking typically a 15 to 30-year liability. It's illiquid, it's slow moving, it's tied to shelter, a basic need. Margin for error is razor thin. So tying mortgages to highly volatile and unproven fintech concepts like direct crypto collateral can introduce risks that the consumers don't fully grasp. Now, where does it belong in mortgages? Maybe, I mean, one of the reasons they're using crypto is because one of the challenges we're facing is how outdated the entire industry is. It is absolutely, I mean, Kirk, tell me what it's like to get financing and buy a new house. It's a ton of fun, right? The system, I mean, the banks are way behind. They're completely broken. So, faster underwriting, better data integration, income verification, credit modeling for non-traditional earners, access, helping international buyers, who don't traditionally meet the requirements that are necessary by our outdated, banking system, or the self-employed. We know this working with business owners. It's like, hey, congratulations, you're worth $20 million, but you've retired and you don't have any income and everything's stored away. Sorry, you can't qualify for a mortgage. Are you kidding me? I had someone with $2 million in liquid brokerage assets in COVID. They got laid off, as so many people did. They had their mortgage completely paid off, but they needed some liquidity. And they decided, we're going to refinance our house. The rates were low. They were told, sorry, $2 million liquid sitting in a bank. I could hand it to the bank right now. Could not get a loan. So we've got to come back where, we've got, and then we go into titling, digitizing title, escrow, compliance. You could shave thousands off closing costs. And again, that would be a disruption because there's a lot of money and a lot of jobs in those lines. And then you had the transparency. Blockchain could add real-time verification of property records, lending terms. Where do we draw the line? I mean, there's cool versus dangerous. Cool is shaving off 2 weeks of underwriting. Lowering the fees. Dangerous is putting your house in line with collateral can swing 30% in a week. If this innovation, you've got to ask yourself, this innovation fails, what happens to the borrower? Losing some trading capital is one thing, losing your home's another. I mean, and then there's the regulatory reality check. Like you said, we've got to have some sort of oversight. And if regulators don't have a clear framework, you tie this innovation to long dated, systematically important assets like housing is highly premature. So, to summarize, what do I think people should be doing right now? You have to make sure you separate speculation from foundation. Use crypto, DeFi, other fintech for growth and liquidity, but keep the foundation of shelter, income, and security anchored in stable financing. Look for blended solutions, innovations like using crypto as an asset for qualification, which is a proof of wealth, rather than as collateral necessarily for margin calls, especially for domestic citizens here, it might strike the right balance. And then you're going to have to stay adaptable because you can't dismiss fintech. It's here to stay. But don't bet the house, literally, on untested models. Treat them as optional tools, not the core. In big picture, lastly, I mean, finance is evolving fast, but evolution doesn't mean every idea deserves equal weight. Winners will be fintechs that respect, they're going to be the Amazons, not the buy.coms. They're going to be those that respect the gravity of long-term debt while improving access, cost, and transparency. And for consumers, experiment with fintech at the edges of your wealth strategy, but keep your house money more conservative.
Yeah, that's great, Doug. So, Diana, what about you? What are some of your thoughts?
Yeah, I have a few. I actually used to work for a technology consulting firm, and I've worked on several with several fintech companies. So first and foremost, I mean, fintech, it's so important, and I see it almost as a delicate technology because if anything breaks, like we're dealing directly with money. And so anything from, Apple Pay to what Milo's doing with, Bitcoin backed lending, you have to think about, and Doug touched on this, right? We talked about the risks. On the flip side, I think this type of out of the box thinking is necessary to push us forward in the fintech space, with or without digital currencies. Now, as we discussed, digital currencies introduces a whole nother set of risks. So it's a matter of, are you willing as an investor to take on that risk for the potential return? So, and that's a very, individual question. Whenever it comes to finance, I always say, ask as many questions as you need to until it's black and white. So we talked about, layering and complexity and understanding what you're investing in. And I think that first and foremost, that's the most important thing. What I will always champion are new innovative ways that create channels and accessibility for investors, whether it's, in this case, it's for borrowing to obtain, a high dollar asset that I think these investors specifically could probably pay cash for, right? If they wanted to liquidate their Bitcoin. Well, Milo, they created an avenue where they don't have to liquidate their Bitcoin, where they can get the lending they need in a matter of, I think as early as 24 hours, but we'll say weeks instead of months. Um, so creating these avenues to get lending, to find ways to serve, underserved, we'll call it, communities that have certain goals around investing. Like I said, we'll always champion that. Related to this, one thing that comes to mind, because I know the company Robinhood came up a few times, so I'm going to jump on that, is, Robinhood earlier this year, they announced that they were going to tokenize US stocks and ETFs to make that type of, more accessible, those assets more accessible to EU investors. And I think that's incredible. So I'll always be a champion for those creating these avenues, but I absolutely 110% agree we need to understand the risks. I'll quote Warren Buffett, it's hard enough to make money in what I do understand, right, in investing. So if there are these layers, just make sure that you understand what they are, look at alternatives, do your due diligence. This is the ex-auditor in me talking right now, but it is so important. No investment, or as I say, trade, because former options trader, no investment or trade should ever keep you up at night. So and that's what I'll close my thoughts on that for.
Yeah, I would agree with that. I think that's a great way to think about it. Is nothing should keep you up at night. I mean, if you're doing something that you can't sleep, it's probably a bad idea. Um, you know, I will say I've heard some interesting ideas over time. And there was a guy I followed for decades, and he's a financial writer. And he at one point, I forget when, maybe it was 2012 or 15 or something like that. I forget the exact date, but he got a mortgage in yen. He lives in the US. And his thesis is, well, the yen is going to decline. And um, so, you know, the way to think about these financial products, or in some ways I call it financial engineering, right? Any anything you do, you're giving something and you're getting something, you're taking something, right? So if I go buy, Kit Kat, I'm giving them $1 and I'm buying the Kit Kat. So I'm shorting my dollar, right? I'm selling it, my dollar, and I'm getting a Kit Kat. So to me, the Kit Kat's worth more than the dollar. Okay. If I buy gold, I'm shorting gold and I'm going long. I'm sorry. I'm going long gold and I'm going short the dollar, right? Because I'm exchanging my dollars because I think it's going to be worth less. So I exchange my dollars for gold. So you're always exchanging one thing for another. And I want to use this framework because I think it's hard for a lot of people to conceptualize these complexities in the financial markets. And all it is you're giving one thing for another thing. So in a mortgage, and I've told people on the live show, I'm buying a house finally. I'm going to stop being a vagrant and buy a house. So we're buying a house, we're getting a mortgage, right? We're borrowing money in dollars. And my suspicion is that over time, my mortgage is going to be worth less due to inflation, right? So I'm borrowing money. And what I think is my house is going to be worth more than the mortgage. So let's say, for a safe example, the house is 100,000 and the mortgage is 80,000, right? Just keep the number simple. Over time, I'm hoping my house will be worth 200,000. My mortgage, let's say I'm only paying interest for this example. It's still 80. Well, I've just taken a $20,000 profit and turned it into a $120,000 profit because the mortgage hasn't changed, but my house value has gone up. So I'm buying a house and I'm shorting dollars, right? I'm assuming the dollar is going to be worth less, my house is going to be worth more. That is the exchange I am making. Now, these are simple examples, but the more layers you put on, the more complexity. Well, let's say I say, all right, I'm buying a house, I'm shorting the dollar. Well, someone else has taken that mortgage, and then they're doing something else. They're buying and selling something else, and someone else is buying and selling something else. You're like, well, wait a minute, how does this all work? Well, I don't know, because the complexity gets a little crazy the more layers you put on. So I'm trying to take a simple example and expand it to show you how complex it can get. So if you are putting a mortgage in Bitcoin, let's say, well, now you've got another layer of complexity because it's not just Bitcoin. You're having a mortgage compared to Bitcoin, which I don't know if that's a good idea or not, but let's say it is, just for the sake of argument. Okay, but what I'm doing is I own dollars, and then I have to buy Bitcoin, right? And then I exchange the Bitcoin for my house, let's say, as an example. We've got three layers instead of two. You got two transactions instead of one. So now, all right, well, let me think. What are each of these assets doing in comparison to this house? So now you've got these layers and you're like, oh, I don't know if this is a good idea, right? Because it's hard enough to predict the direction of markets. Where's real estate going to go? I have no idea. And that's just simple dollars for real estate. Where's, Intel going to go, or Microsoft, or gold? Where's it going to go? I have no idea, right? And that's just one layer. That's just dollars for that asset. Well, what happens if you got 3, 4, 10 layers in it? Well, good luck, right? Diana plays in the derivative world. How would you like to get stock options on the VIX, Diana?
Oh,
That's derivative upon a derivative. It's like, I don't know. Right. It's like, who knows? Like it gets, when you think like, all right, I understand how this works, and then you add another layer to it, you're like, well, I don't know, my brain could do that. So what I'm saying is it's not necessarily a good or bad idea. I love the idea that Josip's doing this. I love that there are companies out there doing this because I think it needs to happen. However, what I'm proposing is that you don't just do things because they're new and interesting, in that you do them because you understand that you are going to benefit in this way, right? So if I'm buying real estate, I want to buy it when it's low, right? I want to buy it when it's low. I want it to buy it when there's positive inflation. If I buy it when there's negative inflation, well, I'm up the creek. It's like Japan, 30 years of deflation and your real estate goes down and your mortgage stays the same. You still owe that money. Your house is now worth a lot less. And what do you do? Well, I don't know. So the point is you need to understand these dynamics and how they work and not just get get caught up in the excitement of doing something new and different, but really understand, is it a good time? Because, if crypto's high, or Bitcoin, let's say in this example, Bitcoin's high in price, and you'll benefit if it goes down. Okay, well, maybe that's great. But if it's low, maybe it's not, because maybe you'd rather own the Bitcoin rather than the mortgage. So the point being is just understand how these things work. It's hard to unravel a mortgage. It's probably harder to unravel one that's not traditional. So just do your research. We always talk about in the show, do your research, understand what you're doing. I think, like I said, I think it's a great idea. I'm glad it exists. I'm glad people are doing it because it is going to change the financial markets for the better, in my opinion. I just think people just need to fully understand what's going on and not just dive in without, as they say, as Gordon Gekko said in the movie, a blind man without a cane. You don't want to be that. So, all right, as we kind of wrap it up here, final thoughts here, Doug.
Yeah, so there's about a series of things that I wanted to kind of add in there that I think are some really interesting ways, again, because we kind of talked about the risk and kind of talked about the concerns, but there are some things about this that I think really get laid out there as real challenges that are going on right now. First of all, there is wealth beyond the U.S. borders. International investors want U.S. real estate. They as much as we hear in the news right now that everything in America, nobody wants to be here, nobody wants anything to do with it. The reality is there is still a trust in the stability rule of law, for the most part, long-term appreciation, and the U.S. banking and mortgage systems aren't designed for global citizens. This kind of fintech helps have collateral for international accessibility and reduces friction. Crypto as a store of value meets real estate, whether it's Bitcoin, Ethereum, digital gold. Do they rival U.S. real estate as safe havens? The question, that's a question. Convergence of assets. Using crypto to buy tangible property without liquidating. There's the volatility of digital versus illiquidity of property that has to be managed. There's limitations in traditional U.S. banking system. We've talked about it. Regulations, it's outdated. There's billions locked up in global wealth that are unable to flow into our markets. That if we can make that better, that's going to be incredible for our GDP here. And it's going to really help our economy in many ways. Yes, there will be disruption. Crypto-backed mortgages would fill that gap. Uh, the finance, it's evolving. From Goldman Sachs to Milo, what he's doing represents a shift from Wall Street tradition to fintech innovation. The new consumer is going to be global. They're going to be mobile. They're going to be asset diverse. They are skeptical of banks. Wealth is redefined from income streams and assets and creditworthiness. They're changing in the blockchain era. And that role of blockchain it's going to be going beyond speculation. Now you're starting to see practical uses like collateral, lending, and ownership verification. You mentioned Robinhood, the democratizing of finance. That blockchain infrastructure scales it globally. There's opportunities, the tokenization of real estate, fractional ownership, global liquidity pools. Those are things that can happen. Then you've got, is crypto or real estate complementary or competing? They're very different asset classes. One is volatile but liquid, the other is stable but illiquid. There is synergy through mortgages. So using crypto to access real estate, that balances risk profiles. The bigger question, which will dominate as the store of value for the next generation, is hard to tell. And lastly, there is an international appetite for U.S. investments. Why the U.S. still matters is we still have a rule of law that is fairly where there's a fair amount of confidence in. There's still dollar dominance, whether you want to believe it's not or not. Sure, it's waning. You and I have talked about those cycles. There's cultural appeal. Global citizens are no longer relying only on those dollars. They want digital assets integrated, and cross-border capital flowing is becoming as easy as sending it through email. So those are a few last thoughts I want to throw in there, but to wrap it up, here's the truth. Whether what we're talking about fintech and mortgages or how families pay for college, the constant is change. The rules evolve, the lending guidelines shift, the restrictions tighten, and the old playbook stops working. We see it right now in education finance. One massive, big, beautiful bill can change the entire landscape overnight. Private loan rules are narrowing. The options that worked yesterday may be gone tomorrow. And for affluent families, this is where planning matters most. You can just hope the system will work in your favor. You have to design a strategy. You can't just hope that the system will work in your favor. You have to design a strategy that adapts, whether it's protecting wealth, buying real estate, or funding the next generation's education. And that's where the line gets drawn between cool innovation and real financial strategy. Use what's new and useful, but never gamble your foundation. And so, if you want to see how those principles apply directly to college funding strategies, visit us at www.mergentcollegeadvisors.com. That's MERGENT, or emergentadvisors.net, because at the end of the day, planning is going to beat hoping every single time.
Great. Thanks for coming on, Doug. And Diana, final thoughts from you.
Sure. So I think Milo's story is really about how finance is evolving and how technology is being leveraged to find new avenues to invest. So as I mentioned, I'm a big champion, but do your due diligence, just like with any investment. As Kirk mentioned, I spent a good part of my life as a professional options trader. Love, love, love trading options. The most important part is whatever you're invested in, understand the drivers of the value of your investment, whether it's, your investment outright in a stock, for example, or a contract that derives its value from that stock, or in this case, in mortgage lending. So that's the most important thing here. And going out, and taking, making bold moves from an entrepreneurial perspective, thinking out of the box, making that bold move, creating these avenues, taking on that risk as essentially a broker, I would say, and building a structure around that. I mean, there is risk involved, but that's how we move forward from a technology from standpoint. I think societal standpoint, not to get philosophical, but really neat things are happening. Do your due diligence. It's your money. You worked hard to earn it. And yeah, so that's all I got. I'm Diana Perkins. I'm founder of Trading with Diana, obviously a former professional former options trader and licensed CPA. And if you'd like to learn more, you can visit us at tradingwithdiana.com and schedule a call.
Awesome. Well, thanks for coming on, Diana. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.